Hi guys, welcome back to the channel. If you've worked with me before in the past, I'm a real stickler about process compliance, trade compliance, executing a plan according to its rules. But every once in a while, you break a rule. I did this week, and I'm kind of pissed. I always find myself held to a particular standard, not just for my own trading and my managed accounts, but also for the members that I help coach. I'm a real stickler when it comes to compliance. And when you break your own rule, it's kind of held to a double standard. Well, I thought about this and said, what are some of the rules that maybe are good to break, or maybe one that has a little more flexibility? So the question is, are there certain rules that maybe be allowed to break once in a while? The one I'll show you in a second actually saved me about $7,800. So no complaints. And I have a whole list of them that may be justified if they meet your criteria, and I'll show you how to get that in a second. But let's go through a short list of rules that I think may be justified to break once in a while. I want to hear your comments as well. Let's have a good debate about it. Number one, when it's preventative in nature. By this, I mean maybe you've identified the right setup, but you're just not feeling it. Maybe this is some intuition that's saying, you know what, I'm done. Or maybe you just had a rough night's sleep, or the kids are sick. It's okay to pass on valid setups. That's why we call them phantom trades. Track them. See how much you would have done if you had traded them. But it's okay. There's always another trade. And quite honestly, being forced to take certain trades sometimes doesn't help you in the long run. Listen to your intuition. Remember, there's always another trade. Number two, when your open trades are too correlated to a certain index. And by that, maybe you're long too many S&P stocks or Dow stocks. Or how about that US dollar? Maybe you have 3 or 4 open positions and they're all USD pair related. It's okay to maybe take some off, even if they haven't hit your target yet. It just makes sense. So if you find yourself too overly correlated, and that can happen sometimes, maybe you have a bunch of pairs, but maybe other ones hit your target and all you have left are USD-based pairs that are open. Happens all the time. Make some proper decisions at the portfolio level to chip away at those so you have your exposure reasonable and one that can accommodate your winning ways, but at the same time, not put you at too much risk and portfolio risk of ruin. Okay, number three, we kind of hinted at number two. Any decision that's in the best interest at your portfolio level. We spend so much time focusing on executing a trade, and it's almost like it's in a bubble. But really, there may be decisions that have to be made when you look at your entire portfolio. Maybe I'm just too long equity stocks. Right? That's great if you're in a bull market, but when it turns, you're in trouble, even if every trade individually you have is valid. And that's what happened to me last week. This is where I broke my rule, in a sense. I was too long with too many equity stocks. It's a good problem to have in a bull market. But what happened was I had too much exposure, open positions, open gains, but I hadn't taken any off the table. A lot of them were very close to my targets. So taking profits too early is actually a violation of my rule. But when you look at the portfolio level, I had to do something. And that's what I did in these particular examples. CIFR, right? I took some off. And CLSK, right? They were high runners. I was really excited about them and almost hitting my second target. But I decided to bail, and it turned out it actually reversed and saved me about $7,800. Great decision. Will that be the case every time? Probably not. But I had to make a portfolio decision, and that's what I did. And I'm sticking to that and making a note in my journal about the quote-unquote rule break. Number four, when your account hits some form of milestone. Maybe it's an achievement that you've always wanted to achieve. Maybe it's like a round number in your account. Now, I'm not a big proponent of watching P&L. I'm really about focusing on the process. But we do have certain goals, and if some of them are monetary, and maybe you hit like a 20,000 account gain or something like that, or maybe a $50,000 account value, and you really worked hard for it, and you just want to flatten out and just enjoy the moment, I think confidence is equally as important, if not more, than profits. And if you forgive some maybe future profits, or maybe some of those stocks would have run, but you savor that moment, I think it's an achievement and well worthy of breaking a rule. Okay, number 5, adjusting size when you're just about to win a prop firm challenge. Sometimes we have to face reality. It's a challenge. We want to get funded, and we'll do whatever we can to do it. We don't want to break too many rules, but sometimes we may want to go for it if we're like 1% away from hitting it. Or if we're almost there, cutting back on size to have one good trade and getting funded. Secure that funding. Let's face it, that's why we're here, to gain that funding. Maybe you break a little rule. We don't want to do it in a live environment all the time, but if we have to make sort of minor adjustments to get the funding, I'll close my eyes if you do. Okay, and number 6, a little bonus one here. When the risk manager tells you to close a position. This is somewhat frustrating and difficult, particularly if you work for prop firms or you're managing capital. Sometimes the firm has an intention and they also look at their risk of ruin and maybe overnight risk that they're holding. And maybe say there's correlation. A lot of people on the desk have a certain position, or they're too long equities or too long tech. And you just have one position, maybe in NVIDIA. You're just minding yourself, you're following your plan. But the risk manager tapped you on the shoulders and said, we got to close your position. The firm is at risk. Sometimes you just have to bite the bullet. And it's kind of like the quirky thing about trading firm capital. It sucks sometimes. And those trades, they always end up winning. But it's the price you pay for working for a firm. And it shouldn't happen too often. But every once in a while, I have to give the tap. And I've been on the other side of that. And it's frustrating. But just embrace it. Enjoy the fact that you're there. And trust me, it will even out the longer you're there. Now, one little hack to get around this is to include these rules in your trading plan. So on the selective basis, you can use them and you're really not violating any of your trade rules. And this also goes for prop firm traders as well. But I'll make it easier for you. Just click on the link below. I'll have a list of all these rules and the criteria which allows you to use them. They've worked well for me personally, for the teams that I coach, and also on the managed and prop side. I hope you enjoy it, and we'll see you next time.